And hopefully at the end, you'll have a better understanding of your grants and if you're tracking them properly and some fun ways to track them in your accounting software. So just a quick overview. We're going to go over grants. First, we're going to talk about understanding your contracts. So knowing your grant terms, understanding your revenue recognition, and we're also going to go over the various types of grants that your organization could receive. And after that, we're going to get into some record keeping. And we're going to talk about some best practices for tracking your funding sources and tracking your programs. And Angela is going to kick us off with contracts.
All right. So you may be saying, why should I read my contracts? They're long, they're boring, they're confusing. I don't have time for that. So I'm pretty sure everyone everywhere has said this, but there are good reasons for reading your contracts. So your contracts are going to determine both when you recognize your revenue and the if, when, and how you get paid. So do you have to voucher? Does it get paid up front? We'll go into all of those details throughout this presentation. So in understanding your contracts, obviously you don't want to read the entire contract verbatim, but you need to make sure you understand what it is you're looking for and what you need to understand. So what's your term, the time period of performance? We'll talk a lot later about expense reimbursement versus milestone grants. You need to know your time period of the program to know when your expenses are allowable. So what's your total award? Keeping track of how much money you have to spend and are you on track for your budget versus the time period for your program? What those payment terms are, vouching, prepayment, how and where you draw down your information, the conditions and or donor restrictions. We'll go on a lot about that later in our presentation. Any kind of reporting requirements, what your actual budget will be for your contract, and any compliance requirements. So here we have a sample contract. This highlights a number of items that you want to look for right away. This might look very familiar to a lot of you if you have federal or state contracts. A lot of them are going to have a very standard format with the first few pages breaking down those items I just talked about. So I've got highlighted your account number, your budget period, what's your total budget. This particular contract, the very next page shows you your approved budget broken down between salaries, equipment, etc. Not every contract is going to have that right in the first few pages. Sometimes it's in a supplemental schedule at the back. Sometimes it's in a different document. What's important is that you are keeping all of these contracts and documents together and easily accessible for yourself to go back and reference if and when you have questions. So again, in the standard contract example, so this is approximately page 3 of this particular contract, standard terms. So it's saying who and how you're getting paid. This particular one says paid by the DHHS payment system. So that means that the organization receiving this particular grant needs to log on to an online portal. That means that they need to be registered for that portal in order to get paid. It notes that any applicable statutory or regulatory requirements, including the 45 CFR Part 75, apply to this contract. You might, before this presentation, skim over that, shrug, and not give it another thought. This, however, is actually very important. That 45 CFR Part 75, CFR stands for the federal, stands for the federal registry, and they tell you exactly what it is you need to be doing for your contract management. That includes specific fiscal regulatory items, such as going out to bid for expenses, making sure that they're reasonable. Elaine mentioned earlier that the IRS is asking, have your organizations been paying out to related parties? Are you paying more than is reasonable for expenses? The CFR goes through and says, here's what is and is not allowable to be applied to these particular grants. So that's important both in your grant contracts and also your IRS information. Moving on to the next slide. We have, this particular contract gave a very nice summary of all of their documents attached, including your reporting requirements, your instructions for getting your payment, any audit requirements, specific conditions and remedies for noncompliance. So your audit requirements, sometimes your contract says you need an audit, sometimes your board says you need an audit. Either way, you need to make sure that you're tracking your grants based on their terms and conditions to make sure that you can provide this information either to your auditor, to the IRS, or it's really just best practices to know what your organization is doing with their money to make their program successful in the community. So on this sample contract, we'll note while this grant does not explicitly use the term expense reimbursement, in reading the terms, it tells us that this grant is an expense reimbursement. Down at the bottom there, it says timing of distributions. It notes that funds must be used within 3 days of taking a drawdown. So this particular grant says that you can go online and pull down money at any time. Other grants may say, hey, you will not get paid until you have already incurred the expenses, in which case you present a voucher to the granting organization. You say, here is an itemization of all the expenses I've used. Now please pay me. On the other hand, some grants may allow you to draw down money ahead of time. However, this particular grant notes that the funds must be expended within 3 days of getting that cash. That says that that's not an operating grant. That still says you must spend this cash on specific grant related expenditures in order to be entitled to those funds. So when in doubt, reach out. There's a lot of information in every single one of these contracts. Some of them are 10 pages, some of them are 100 pages. You really need to make sure that you're skimming through, looking specifically for your contract requirements, those terms, restrictions, etc. So if you have questions about your grant requirements, where are you going to go? You can check online. So does your granting agency or the grant program have a website with an FAQ? Do you have a direct contact? Does that grant application or award have a contact email right on the face of the award page? If you're being proactive in communicating with your granting organization, if you're making a good faith effort to comply with your grants, that's going to go a long way. Tracking grants is complicated. There's a lot to keep track of. If an organization accidentally does something outside of the realm of your terms, if you self-report, most granting agencies are going to say, you're making a good faith effort, you're okay, don't do it again, fix it going forward, and then you can continue serving your communities.
Yeah, just a quick comment to that. Some of my experience with a couple of my clients recently, the granting organizations really appreciate when you reach out in the beginning if you don't understand, because then they really get the good feeling that you are committed to making sure that you're doing this correctly, spending down the funds correctly, keeping the right reports. So don't ever be afraid or feel like you're going to bother them. I've recently had to reach out to New York State 3 times in one day, and they were more happy to hear that I was just trying to do the right thing. So just don't ever be afraid that you're going to bother them. Always reach out.
Absolutely. So why do we care about what these grant contracts even say? Really, there are conditions to your revenue recognition. Some of the information I'm about to go through might be familiar to some of you. If you attended our presentation a few years back, there was a new accounting standard for not-for-profit revenue recognition that really went through and tried to clarify when you were allowed to recognize your revenue, because there weren't standard practices between organizations. There wasn't really a great understanding in the community about whether something was a donor restriction or whether it was conditional. And the layman may say those words sound the same to me, but they are not. So there could be a donor imposed condition on a gift. So that's when there's a barrier for a nonprofit to overcome something to be entitled to the resources, AKA, you don't get to keep this money until you do a thing, until a certain amount of time has passed. And if you don't do that thing, there is a right of return of the resources. So if you don't do the thing, you have to give the money back, or if you don't do the thing, you're not going to get the money in the first place, like an expense reimbursement grant. That would be conditional. The condition is met once your expenses have been incurred. A barrier, the nonprofit is required to achieve a measurable outcome, aka helping a specific number of beneficiaries, for example. The nonprofit is required to overcome a barrier related to a primary purpose of the agreement. And this does exclude trivial or administrative requirements. So if a grant says at the end of this period, you are required to submit a final report on the program outcomes. A reporting requirement like that, that is separate from how you're getting your money, that's not going to constitute a barrier. The nonprofit has limited discretion over how resources are spent, a requirement to follow specific guidelines incurring qualifying expenses. Again, those are your expense reimbursement grants based on strict budgets, saying how, by what line item. That differs from a general award that says, hey, use this money, for example, for your executive director's salary. So conditional says, do the thing, or the money is not yours to keep. So we have a nice little slide here that goes through and puts this visually for you. So is there a donor imposed condition? If yes, it is conditional. You recognize your revenue when the conditions are met. So if you've received the cash, haven't met your condition, that's a liability for your organization until you have done the thing that grants you the rights to the money. If no, it's unconditional. So in that point, you recognize your revenue in an appropriate net asset account. So your equity accounts for those who aren't directly working nonprofits, I'm sure most of you are. If you haven't received the cash, but have received an unconditional promise to give, you can record and should record that as a receivable at year end. So you have your conditions. Next, we have our donor restrictions. So are there restrictions limiting the purpose or timing of the grant? If no, it's unconditional. If yes, it is unconditional and with donor restrictions. If no, it is unconditional without donor restrictions.
So we have our first polling question. If you read through a new grant and are still unsure of the requirements, what should you do? A, sign it anyways. B, take an educated guess. C, reach out for clarification. Or D, read it 5 more times. Hopefully everybody's picking C.
I see some front runners. Well, C is mostly our answer right now. I see a number of people have also said, read it 5 more times.
That might not be a bad idea either.
Right? Say, I like your style. I personally like to make sure that I've given it a good go to make sure that I understand. When you do want to reach out to your resources, it's good to have specific questions prepared to go over if you know relatively if there's one small thing versus the contract at large. Expediting, if you have like one sentence in this grant that says, I could read this 3 different ways, which is it? That's going to expedite your meeting compared to just, could you explain this whole contract to me?
So now we're going to get into some of the types of grants that your organization might be receiving. We're going to go over unrestricted grants, cost reimbursement grants, milestone grants, and then we're also going to cover the donor restricted grants, which include time restricted and purpose restricted. So the first one we're going to go over is unrestricted grants. So we have a definition for you: a financial contribution to an organization that can be used for any purpose that the organization chooses. These are also referred to as general operating grants. So I'm sure some of you have heard that term before. So unrestricted grants are more flexible than grants intended for a specific purpose or project. So you could use these for your general operating expenses, such as salaries, your overhead stuff, such as utilities, basically anything that maybe one of your specific grants might not cover. and it can also fill gaps in your program funding. So we'll get into this a little bit more later, but sometimes your organization has a program that is really important to your mission and you really don't want to cut it from your programming. And some of these operational grants can help you keep that program running. So that's really, really important. So for reporting, unrestricted grants do not typically come with any reporting requirements. But although unrestricted, it's important to know how you are spending your funding. So again, while the grant that you're receiving might not be requiring that you're submitting monthly or quarterly or an annual report, it's still really important for you as an executive director, the employees, the board, to really make sure that you're paying attention to how you're utilizing this unrestricted funds. This will help contribute to better decision-making for your organization and the ability to budget and forecast more accurately. For revenue recognition, you're going to recognize the revenue when an unconditional promise to give has been received. So again, this is an unrestricted grant. So as soon as you receive those funds, you'll be recognizing the revenue on the day that you receive those funds. So making sure that you are properly tracking and paying attention to these unrestricted grants really helps build trust with your donors. When funders offer unrestricted grants, they expect the organization to demonstrate a high degree of responsibility with record keeping and reporting. And I know that Angela and I have both seen this personally with a lot of our clients, that the better you are at your record keeping, the more likely you are to get higher funds and more funds from different organizations. We've unfortunately seen some clients receive less funding because the granting organization realizes that they're struggling with their internal reporting. So it really is important to just make sure that you're tracking all this. Your record keeping is very clean and organized. It will definitely help you gain trust with the foundations and granting organizations that you're requesting money from, and hopefully help you get more funds in the long run. And this goes to the saying of longevity. Unrestricted multi-year funding can help support longevity by allowing the organization to build relationships, refine their practices, and continually reevaluate their programming. So again, the more organized you are with your record keeping, the transparency and honesty with the granting organizations, the more likely you are going to be able to receive these funds and potentially get multi-year funding from the same organization to continue on, refining your mission, making sure your programming is going the way you want it to go, and so forth. So next, we're going to go over cost reimbursement grants. The definition is that a grant that allows for the billing or vouching of costs as they are incurred. The grantor reimburses the grantee for actual costs of the project. Very important keyword is actual. The grantee is typically paid monthly or quarterly. And this goes to what Angela spoke about on the contracts. Really important to read through those contracts because they'll be able to tell you when you're going to get paid, if it's a monthly or quarterly. I've seen a few cost reimbursement grants be just one time. So they might give you $10,000 for one specific thing, and you have to spend that all down, submit your reporting before you're going to get reimbursed.
And occasionally, even though it's a cost reimbursement grant, you may be able to draw the funds ahead of time, but it's still a cost reimbursement grant. I had one particular organization I worked with run into some trouble there because they essentially had access to a portal that allowed them unrestricted draws, in that the system did not prevent them from drawing down a particular amount or require specific documentation at that time. So they could draw down as much as they needed for their general operations, but the grant is still written that this money must be used in accordance with their budget for expenses related to the program. And now they're having to go back through their record keeping because it was not detailed enough. Christine's going to go in great detail about ways that you can track these expenses. And they're having some significant issues right now because they drew that money down on an expense reimbursement contract ahead of time and didn't have program-related expenses to cover it.
Okay, so for expenses, expenses are incurred upfront and then vouchered to the granting organization for reimbursement. Expenses must be in accordance with the grant budget. This is super important. My department often sees this happen where expenses are trying to be put to a grant and we're really making sure we're focusing on that detailed budget, because if it's an expense that is not outlined in your budget, the granting organization will reject it and they will not reimburse that. So it's super important. It'll help you plan for your organization better and make sure that everything's going right, that you upfront make sure you're putting these proper expenses to the grants. I hate to see when clients put an expense that doesn't get reimbursed and then they've passed the period of being able to put it against maybe another grant that might have covered that expense if they had been paying a little bit better attention to where they were allocating these expenses. So super important to make sure you fully understand your budget and you're using those expenses in accordance with that budget.
And going back to our comment about communication, some granting agencies do allow you to request a budget modification. That may be an option, but you want to make sure that you're tracking your budget so you can ask for that budget modification ahead of time. I would say in this case, it's better to ask permission than forgiveness. The other way works sometimes, but get those budget modifications if you need them. You don't know if you need them if you're not tracking it.
Yes. So that brings us to our second polling question. Does your organization keep detailed support of expenses? A, what are receipts? I hope no one says that. B, no, everything is a mess. C, yes, very detailed documentation. And D, I'm not sure.
I think we should say hopefully no one chooses what are receipts and then more people will choose it again. That's what we learned from Taylor.
Yes. Hopefully I see a lot of C's. I know that there might be some B's because I've experienced it.
Yeah, I see a handful of B's. We do have an accounting services department that does provide consulting. If everything is a mess and you're just drowning.
Yes, reach out. We love to help. This topic probably gets me too excited. I love to help clean stuff up.
Mm-hmm. We're not accountants. We're people who do puzzles for a living. All right, so most of you chose C, so that's fantastic. It's what we love to see.
That's good. Makes me happy. All right, so some more stuff about cost reimbursement grants. So for voucher documentation, this is kind of why we asked this polling question before this slide. Receipts must be submitted with the voucher. If you don't have a receipt, you most likely are not going to get reimbursed for it. Now, I do know that some of the granting organizations, I'm sure some of you have heard of the system CAMS, where you're required to log in and you fill out your expenses for the month in accordance with your budget. They don't actually require you to upload your documentation, but we highly, highly, highly recommend that you still prepare the voucher as if you're required to submit the documentation, because somewhere in the little fine print of that contract that Angela says you really need to read, it says that at any time they are able to request and audit your receipt. So I've dealt with this recently with a client over the summer. Going through an audit and not being able to find receipts is a bit of a nightmare. So organization is key. Save all those receipts, document. Very, very important. So that you can make sure that you don't come to a chance where they might audit you and you don't have the receipts, and then you could potentially be required to return those funds.
And later in our presentation, Christine's going to talk a lot about using profit and loss by class. That's the QuickBooks term. Other systems have similar reports by different names. I've run into clients where they will submit an original voucher and the vouching agent or the granting agency will come back and ask them to change something. I will note that if there are changes to your vouchers after an original, you want to make sure that you are updating your general ledger system and your records to reflect the edited item, the final thing that you got paid for, the final thing that was submitted to the granting organization. Because if your general ledger doesn't match what you vouch to your granting agencies, then that makes it nearly impossible to audit, and makes it nearly impossible for the government to audit, in which case they might try to claw back those funds from you.
Yeah, that's very important, and we will get into more detail at that towards the end of the presentation, where I can kind of give you some tips on how to make sure that you're tracking that properly. So for revenue recognition, revenue is recognized as the expenses are incurred, typically monthly, even if the vouchering process is on a quarterly basis. Invoices are created to reflect the anticipated revenue and receivable for the month's expenses. So again, as Angela said, you're incurring those expenses as said in the contract, but you can't receive the money back as a reimbursement until you've submitted documentation with your voucher. And you obviously have to get through, okay, the month of November, we have to finish November before we can fill out our documentation and support all those receipts to submit it. But when you're preparing those November financial statements, you're going to want to create an invoice in your financial software so that your revenue and your expenses equal and net to zero, because you're going to receive those funds back.
If your accounting system will allow it, a incurred not yet billed account could be good for this. Just to indicate this has not yet been vouched. However, we are entitled to the expenses because we are entitled to the money because we've incurred the expenses. If your system can't do that, you can just put it in AR. Just make sure that you're making a note as to when that actually gets vouched.
Yes. So this kind of ties into timely submission. So it's really important to stay on top of timely submissions with accordance to the grant guidelines, whether that be monthly or quarterly. Failure to adhere to timely submissions can cause serious cash flow issues, especially for smaller organizations. So I have experienced this with a couple of my clients. Sometimes this is just due to turnover with staff. It's super, super important to make sure that because you're fronting this cash, and it could be a month before, even if you're super timely, it could even be a month before you get that money back into your bank account. So I've had a couple instances where our client was 18 months. Yes, 18 months behind on submitting their vouchers. They were at a point where they almost were not able to make payroll. They didn't know what to do. And it can cause serious issues, even if you aren't a small organization. You could have large grants. One of my clients has a grant that's $1.7 million, and they can only submit a voucher quarterly. So sometimes those vouchers are $500,000. That's a lot of cash to front. So it's super important that as soon as that month closes, you're making sure that you're organizing all that data, filling that report out, and submitting that as soon as you can, because the faster that you submit it and the more accurately you pay attention to that budget and those receipts, the faster you're going to get that money back into your bank account. So just a quick example. The organization incurred $2,565.23 of expense in the month of December. So what you would do is an invoice would be created for $2,565.23 as of 12/31/2024 to reflect the amount that should be reimbursed by the grant. And this invoice will remain in accounts receivable until the voucher has been prepared, submitted, approved, and reimbursement has been received. So kind of to what Angela said a couple slides ago, for one of our clients, every month we provide an accounts receivable aging detail report, and we have a little note section on the right that specifically lets them know where we are at with that specific voucher. So it might say, we will be submitting by January 15th, or this was submitted on November 10th, or we received this payment December 6th. So whatever month we're closing out, we're making sure we're making a note on that so that the board and the executive director has a better understanding of where we're at with what's sitting in AR and kind of help us with some cash flow. So now we're going to get into milestone grants. So the definition is a funding arrangement where the funds are released to a recipient in stages or milestones as they are achieved. Milestones are specific predetermined goals that indicate important activities or stages of development in a project. And these are also referred to as measurable performance. There should be enough milestones to measure progress, but not so many that they are difficult to manage. Reports on milestones are typically done on a quarterly basis, but can be requested as often as monthly. So in a milestone instance, you might be required to send a report in to show that you've met such milestone before you're going to get a piece of that payment or the full payment, whatever your contract specifies. Failure to meet milestones can result in renegotiation, acceleration of effort, and possibly the termination of the grant. So very important, again, to pay attention to that contract, what it's outlining, making sure that you're really focusing on meeting those milestones so that you're able to get those funds in. So we're going to go over an example. A local foundation gives the organization a grant in the amount of $100,000 to provide specific career training to disabled veterans. The grant requires that the organization provides training to at least 2,000 disabled veterans during the next fiscal year, 500 per quarter, with specific minimum targets that must be met each quarter. The foundation will only give the organization $25,000 per quarter if it demonstrates that those services have been provided to at least 500 disabled veterans during the quarter. So the organization determines that the grant should be accounted for as conditional because there is a condition that needs to be met in order for them to receive the funds. The agreement contains a right of release from obligation because the resources provider will only transfer assets if the organization provides training to at least 2,000 disabled veterans during the year with a minimum requirement of 500 disabled veterans per quarter as specified in the agreement. The foundation requires the organization to achieve a specific level of service that would be considered a measurable performance-related barrier in the form of milestones by specifying 500 disabled veterans per quarter. In this example, the organization's entitlement to the transferred assets is contingent upon serving at least 500 disabled veterans. The contribution is recognized as revenue as the milestones are met. If an advance is received, it would be recorded in deferred revenue until the milestone is met. So we're on to our third polling question. Your organization receives a grant to support your senior program with transportation to and from doctor's appointments. What type of donor restriction is this? A time restriction. B, it is not considered donor restricted. C, a milestone. Or D, purpose restricted. See a lot of answers coming in for D, purpose restricted. A couple that say it's not considered donor restricted and a couple that say milestone.
So what I would say, if I were in the audience, I'd be sitting behind the camera going, I wish I had more information right now. What's the contract say? Right now, it doesn't say anything about a right of return of the assets. So if this said provide transport or give the money back, it's definitely conditional at that point. In this case, Christine.
In this case, it is purpose restricted because they're giving you the funds to provide transportation to and from doctor's appointments for your seniors, and there was no condition.
There was no condition. To say if it were provide X number of rides to seniors and then you are entitled to the money, otherwise give it back, that would be your milestone.
Okay, so now Angela's going to take over with some restrictions.
Yep, so now we're talking specifically about donor restrictions, which is not the same thing as conditional. So condition, I must do the thing or I have to give the money back. A donor restriction says use the money for a thing, period. No discussion about having to return the funds. Really, it's more general oftentimes than a condition. Conditional expense reimbursement grants are going to say use the money in accordance with the budget. I have told you exactly how to use this money. A donor restriction is often more times going to say, use it for a general program, a general purpose. So your definition there, a donation that has a time limit or a specific purpose, and the funds can only be used for that purpose or within that time frame. No mention of having to give the money back. So you can have a time restriction, you can have a purpose restriction. Time restrictions are when a donation or a grant given to the organization that has a set period of time for the organization to fulfill its obligations. The donor may also choose to give the donation in installments over time. So how do you recognize that revenue? Revenue is either recognized when the cash is received or it is shown as deferred revenue until the time the obligation, or rather the donor restriction, has been met. At that time, the revenue can be recognized. Really, you're going to recognize that revenue when the unconditional promise to give is received. They might say, hey, I'm going to give you this cash to be used in X amount of time, but you don't have to give it back. You've gotten an unconditional promise to receive, you recognize the revenue. So here's one example. A local foundation gives the organization a grant in the amount of $144,000 to support the overall mission. However, this grant comes with a time restriction. The funds must be spent within 12 months of the date of receipt. The foundation distributes the entire $144,000 within 5 business days of receiving the signed agreement. The organization determines that the grant should be accounted for as unconditional because there's no mention of a right of return. The organization decides to recognize the full $144,000 in revenue on the day of the receipt of the funds. If they knew of that ahead of time, if it crossed fiscal years, once they get the unconditional promise to give, they could record a receivable and AR. The agreement specifies that the organization must use the funds to support its overall mission within the next 12 months. Over the next 12 months, the organization must keep meticulous records of the expenditures related to this grant and may also need to provide periodic reports to the foundation detailing how the funds are being used. So one other note on time restriction, I would say that the most often I see a time restriction are for perpetual restrictions, saying that there is no amount of time that could pass. This will always be restricted. That's often for endowments. A donor may give money and say, this must be invested forever. And then you can spend the earnings on that investment, in which case you would get your investment, and then your total investment would be permanently restricted, and then the gains and losses would become unrestricted as you use them for whatever the allowable purpose is. The other one I see often is you must hold this fund for X number of years because I have donated this to the organization, but I want my child to be able to take distributions from this for the next 20 years. And after 20 years, they're on their own, in which case you can keep the rest of that money. So at 20 years, it becomes unrestricted. So various items like that. More often what we're seeing are donor restrictions for purposes. That's the more common one that I come across. So purpose restrictions are a donation or a grant given to the organization that's for a specific purpose or program. The donor or the grantor places restrictions on how the funds can be used as opposed to when. So revenue is recognized at the time it is received or when the unconditional promise to give is received, and expenses are allocated against it as they are incurred. So we've got an example. A local foundation gives the organization a grant in the amount of $85,000 to support the salary of their new executive director. The organization has experienced some hardship over the last year and finally found the right executive director to help get the center back on track. The foundation supports the center's mission and recognizes the importance of being able to fund this position. The foundation distributes the entire $85,000 within 5 business days of receiving the signed agreement. So the organization determines that the grant should be accounted for as unconditional It doesn't say give the money back if you don't spend it within X time. The organization decides to recognize the full $85,000 in revenue on the day of the receipt of the funds. They got it right within the time of the contract being signed. Again, you can record a receivable at the time an unconditional promise to give is received. The agreement specifies that the organization must use the funds solely for the executive director's salary. The organization should keep meticulous records related to the executive director's salary and may also be required to provide support to the foundation. Just because a foundation doesn't require support, doesn't say you have to give this money back, doesn't mean you shouldn't be tracking it. As a nonprofit, you have a responsibility to the community to be using the funds in the way that your donors have requested. They've entrusted you with this money for the support of the community. It's your fiduciary duty to spend that money as directed by your donors. So in this case, your restriction is released as the salary is expensed. So we've got our fourth polling question. Does your organization track your funding sources properly? Do you think you are?
Ooh, lots of yeses. Good thing there's no Bs. Oh, yes, but we could be better about it.
Appreciate the transparency.
Yeah.
Say, I want to be shocked to see some no's here. I've worked with a lot of organizations when we come in as auditors where they're tracking their funds by program, but not by funding source. So if a program has both general community donations and separate from that a grant, if the grant's covering that same program, sometimes they're not breaking those out separately when they might need to, based on whether there's conditions, donor restrictions, etc. So most of you said yes. A number of you have said we need to be better about it.
Good. Well, hopefully the next slides will help you figure out how you can do it a little bit better. We're going to get into our internal grant tracking, the importance of internal grant tracking. It allows the organization to properly track expenses among funding sources, evaluate programming, and ensure that there is no double dipping on expenses. I know that people don't like the word double dipping, but it happens more than we would like to see. And some of the things that I'm going to go over is going to help you ensure that your organization is not doing that.
So if you're sitting here going, what does that even mean? Essentially, if you have a donation that is conditional or donor restricted, and you have expenses to go against that, you can't use those same expenses to go against another condition or donor restriction. If you've got a program that says we're going to support youth basketball and we have to pay for the after-school chaperone salaries, and you get a grant to cover that, and then you have a donor that says, hey, I'm giving you a donor restriction, here's some money to support your basketball program. They can't say, that's great, we have a basketball program. It's not restricted anymore. You have to be incurring additional funds. You can't use that expense twice.
Yes. All right, so first we're going to go over the statement of activities, a financial report that shows a nonprofit organization's revenue, expenses, and net income over a specific period of time. This is also known as a profit and loss. So depending on what version you might have in your accounting software, you might see either of these terms when running reports. It is one of the essential financial statements for nonprofits and is crucial for demonstrating how well the organization manages its resources. It can help nonprofits categorize their revenue and expenses and identify the need to adjust programming. Super important here. I'm going to go over a few different reports that you can utilize that will really help you identify these things and make sure that your organization is tracking things the right way. So first, we're going to go over the statement of activities by customer. It's also referred to as by funding source. So each funding source should be set up as its own customer. As Angela said, she sees a lot of clients that utilize the class feature. We use QuickBooks the most, so that's what I will refer to in this presentation. So QuickBooks offers you your customer section, which is how you could invoice people. And then they also offer a class section, so you can create different names for the class sections. And we utilize that for programming. We'll get into that in a couple of slides. But for your funding sources, we always recommend that you use the funding sources as a customer. So for example, if you're getting funds from Onondaga County, you would create Onondaga County as a customer, and then we'll get into how the reports will show you how to track that. So income and expenses can be allocated to that specific customer. So anytime that you're entering, your National Grid bill or a program supplies invoice, you are able to select Onondaga County if that's the funding source that you are going to be allocating that expense to. So here's an example of a profit and loss by customer or funding source. And this is going to be an example of a cost reimbursement style grant. So you can see there's 3 columns: Grant A, Grant B, and Grant C. And you've got your grant income line, but then you can see down below all the different expense lines. Now, these expense lines should correspond with the budget of this Grant A, B, or C, which you'll have in your contract documents. And as you're entering these expenses, you're going to select which grant you want it to go to. One common mistake I see with clients is they think that they need to enter the expense and they just put it to, say, program supplies, and they don't choose a grant funding source. And then they go in and they do a journal entry to separate everything out. So QuickBooks allows you to enter a bill or an expense, and you can separate it out into different lines. So say you have this utility bill is going to go against 4 different grants. You'd have 4 different lines within that one expense transaction that says utilities grant A, utilities grant B, and so on. So sometimes I see that this does seem like a lot of work sometimes when clients kind of try to convolute it. But you really utilize the features of QuickBooks to make your lives easier and make sure that you're tracking these expenses against each grant. And a report such as this will help with that double dipping problem. So you can see your salaries. We've allocated salaries amongst each grant. If you're going in and recording salaries, there is no way for you to double dip if you're utilizing this process, because you're going to enter that amount. So say employee A got paid $1,000, you could put 500 to grant A and 500 to grant B. That's ensuring you that you're making sure you're not putting that person's salary to 2 different grants for $1,000.
And if you had another column on this that was unrestricted funders or just general donors, if you have a negative in one of those expense lines, that tells you, hey, I over allocated my expenses to one of these grants. So it's important to be looking at these reports on the whole basis of your organization, as well as just in the snippets as you look at your individual programs or funding sources.
Yes, and I will have some examples of what Angela just said and how that would look. So for your cost reimbursement example, you see that our revenue, $228,000 on grant A, equals our expenses of $228,000 that we've allocated, and our net income shows as 0. We don't want that to show revenue, and we don't want it to be negative, because if it's showing revenue, you've over allocated expenses to that grant that is not going to get reimbursed. And if you're showing negative, you haven't put in enough revenue to account for those expenses that you've allocated to that grant. So next is a profit and loss by customer or funding source for the same funder. This is just something I thought would be helpful. It's a common mistake I see with some of our clients, and we help them understand why it's important to separate them out. I'm sure a lot of you have seen funding from the Central New York Community Foundation. It's very popular. They oftentimes will give the same organization multiple grants. So in this scenario, we're showing that we received $20,000 for our youth program, $10,000 for our senior program, and $15,000 for some COVID stuff. And we have those separated out. You can abbreviate. Sometimes when you have a lot of funding sources, the report looks a little overwhelming. Oftentimes what we do is export it to Excel and just rearrange the names so it looks a little bit prettier and easier to read. And this will allow you to make sure that you're allocating to each of those specific purposes of the Central New York Community Foundation funds, and you know that that 20,000 for youth is spent down, net income is zero. You know the 10,000 was spent down for program supplies, net income is zero. And the COVID was spent on contracted services, net income is zero. So even if you are getting funds from the same funding source, it can be very beneficial to set them up as their own customer. Next is a quick example of a donor restricted grant. This is a purpose restriction. So in this example, the organization received $10,000 of grant income in May of 2024. And we're going to recognize that revenue in May of 2024. So when you run your financial statements for just May, you're going to see $10,000 of income, but you've only allocated $815.25 of expenses. So in this instance, it's going to show an income. But because this is a purpose restricted grant and you receive the funds up front, you're going to continue to see this as you move forward. So then when we get to June, you see there's no revenue because we recognized it all in the month of May when we received it, but we're continuously allocating salaries, fringe, and program supplies towards this grant. So then you see your net income is negative $2,568.25 because we have expenses, but no revenue. Now, when you get towards the end, when you've spent the whole grant down, you see that our net income is zero. So cost reimbursement grants, every single month, you want to see that net income is zero. But for a purpose restriction, you might be spending that money over a span of 5 months. And as long as you've spent that down by the 5 months, then you're good.
So we actually have a question. What if a grant allows reimbursement of indirect costs? Would that show a profit, or would the indirect costs show under expenses?
So if this is still considered a cost reimbursement grant, then it would still go in your expenses and not show as a profit.
So I've seen many organizations use a indirect cost allocation line. So even if the grant says I may be reimbursed for indirect costs, those indirect costs still need to exist. So you still need to have incurred rent expense, utilities expense, salaries, whatever that dollar value may be, in which case you would essentially do a journal entry for your indirect expense allocation to the funding source that is going to reimburse that amount. And you would reduce, and you would have essentially a reducing line item on your unrestricted funding sources, on your general fund.
All right, we're running out of time, so I'm gonna skim through the next few. So this next example is profit and loss by customer or funding source, and this is just all encompassing an example to see some different types of grants on your P&L. So we have a cost reimbursement A, a cost reimbursement B. They show your net income of zero. Then we have our general fund. So this would be where everything else is gonna hit if it's not related to a specific funding source. So you can see we have grant income of $25,000, but that would be an unrestricted grant, which is why it's showing up in your general fund. And you can see that our general fund has some revenue of $2,240. And then we have grant C, which is a cost reimbursement grant, a net income of zero. And then we have grant D, which is a donor restricted, and we're showing that as income of $1,030 because it hasn't fully been spent yet. And our last one that we're going to go over is our statement of activities by class. So this is also referred to as a program. Each program should be set up as its own class, and income and expenses can be allocated to the specific class. So this is the same concept as the customer. When you enter an expense, you're going to choose a customer and a class. So you're going to say this is being funded by Central New York Community Foundation, and this is for our senior program.
So we actually have one more question. If you receive a gift to be spread over several years, do you have to recognize the gift all in year one and AR for the balance, or can you recognize the income each year that you receive the funds? So this is one of those it depends questions that every accountant hates because we want a straight answer. It depends on what the donor letter says. It depends on what the contract says. So I have seen this happen with the Community Foundation, with the United Way, where an organization will get a donation over however long. If that contract has wording in it that says in this time it is subject to change, then that is actually conditional. It's not set in stone. In which case you can wait to record it until each year comes to pass because it's not unconditional. If it is unconditional, then you should be recording that revenue all up front.
Okay, so really quick, this is our last slide. Just a little example of a profit and loss by class or program. So you can see programs A through E. You see your grant income per program, the expenses that you've allocated. And one important thing that I always let my clients know is pay attention to that net income number because that can help you analyze your programs, see which ones are doing well, see if maybe you need to think about eliminating one. But also a key thing is a lot of organizations have programs that are really, really important to their mission. It might show a loss of $2,000, but maybe that's really important and you have an income in your general fund that can cover that. So just really important to show your programs versus your customers, your funding sources, so that it can really help you analyze your organization and how to keep moving forward.